Hi everyone, and welcome to the solution video for the first homework here in Module 4. And so in this video, I'm going to just walk you through the solution for the accounting for an installment note. All right, so I'm going to write my name in here, Tom. Don't want to lose points for forgetting my name. So in this problem, we have Willie Wynn Track Shoes. So Willie Wynn Track Shoes, that's a creative name. They acquired a machine from Betty Will Corporation. Okay, so they're buying a machine. Betty Will completed construction of the machine on January 1st, 2024. In payment for the $12 million machine, Willie Wynn issued a 5-year installment note. And if you remember, we talked about installment notes are loans where part of the principal is paid back each period. And so it's a little different than, how a bond would work, where the amount borrowed is paid back at the maturity of the bond. Here, we're saying we're paying back some of that principal throughout the life of this loan. Okay, so we're dealing with an installment loan here. So the installment loan is for $12 million, and it's for 5 years. And there is an interest rate of 10%. So what we have to do here is we have to prepare, one, the journal entry for when the machine was purchased, and then two, the journal entry for the first installment payment that's going to be due on December 31st, 2024, which is 1 year after the purchase of the equipment. All right, so let's tackle number one here first. So number one, this is pretty straightforward, and what we're doing is we're receiving a new asset. So we're just going to debit the machinery account, right? Because we're buying a machine, right? So we're going to debit machinery, and then we're going to create the notes payable liability, and both of these will be for $12 million. All right, so pretty straightforward. Now, part two is, and so by the way, this is the solution to part one. Part two is a little more complex because in addition to paying off part of the principal each year, there's also a 10% interest payment. So the payment that we're going to make on December 31st, 2024, that first, where are we at here? Oh, the first installment payment on December 31st, 2024 will include some of the principal, but it will also include interest. Okay, so we're going to pay $12 million back over 5 years, and as we pay off that $12 million, we also have to pay 10% interest. So how do we figure out what the amount of the payment is, or what the amount of the payments will be for the life of this loan? All right, so let's give ourselves some room here so we can work with number two. So I'm just going to erase the solution here to number one. If you missed it, just pause the video and roll back the video to where this was on the screen. And let's look at number two now. Okay, so let's think through this. So the amount of the loan is $12 million, okay? And we have a series of payments where the number of periods is equal to 5, and the interest rate is equal to 10%. All right, so we want to split this up. 12 million, and we want to split it up across 5 payments at an interest rate of 10%. We want to look at the present value of an annuity of $1 then, okay? That is what we want to look at. All right, so basically we're going to find the present value of an annuity factor here, where the number of periods is 5, the interest rate is 10. If we divide by that factor, it will give us 5 equal payments, or it will give us the equal payment amounts for the 5 payments, and it will incorporate 10% interest. Right? So once we realize that this is the approach we need to take, we need to find this factor, then the rest of the problem becomes pretty easy. So let's go find that factor. All right, so we are now in our time value of money tables, and we want to go to the present value of an ordinary annuity, and we want to look for 5 periods. So we want to go 5 periods at 10%, so right over here. So the number we want to use is 3.79079. 3.79079. Okay, so let's just highlight that for ourselves here so you can see it. So we're just going to pick up this number right from the present value of an ordinary annuity table, and we're going to incorporate that into our calculation. All right, so the number that we identified from that table was 3.79079. Okay, so then our annual payments over the next 5 years will be equal to 12 million divided by 3.79079, or 3,165,567. So 3,165,567. Okay. So let's just pause a minute, get everybody caught up, right? So these will be our annual payments over the life of the loan. And we need to record the journal entry for December 31st, 2024. Okay, so let's give ourselves some room. And the journal entry is going to look something like this, right? So we're going to say we have interest expense, right? That's based on that 10% rate. And we're going to be making a cash payment, right? So that would be a credit to cash. And we are going to also we're making a principal payment each period as well. So the value of our notes payable is going to decrease each payment. And the cash payment that we just calculated was 3,160. Oops. I forgot the one. 3,165,567. Okay. Now, how much of that is principal? How much of that is interest? Well, to figure that out, all we have to do is say, well, the effective interest method says take the outstanding balance of the loan. In this case, it's 12 million, and multiply that by the effective interest rate. And so that is 10% here. And so the interest expense is 1,200,000. Okay. So our interest expense is 1,200,000. Therefore, the amount that the principal goes down is the difference between the cash payment we're making and how much is going to interest. So if we subtract 1,200,000 from 3,165,567, we will get 1,965,567. All right, and then this becomes our solution to part 2 here. All right, so the takeaways here are, one, the first entry is very familiar. All we're doing is recording the new asset that we're acquiring and then the loan that we're taking to pay for that asset. The second part of this, we have to factor in the interest that we have to pay in addition to the principal we're repaying through the installment loan. And the way we do that is we take, well, what is the value of the loan? In this case, it was $12 million. And we say, if we were to split that up so that we would give the lender 10% interest on it over and above the $12 million that was lent, how would we figure out what the equal payments would be over those 5-year periods? And the way that we do that is we find the present value of an annuity of $1. We find that factor in the table, and we divide the 12 million by that to get the first part of this journal entry here, this 3,165,567. All right, well, I hope you found this video helpful. Thanks a lot for watching. I'll see you real soon. Take care.